You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, good morning, Jim. Good to be with you.
Equity markets showing so many nice little bounces and then another few days of decline. Is this going to be a constant program for the next while?
Well, to look at the big picture, Jim, 2015 was a very good year for us. And early, I think it was Valentine's Day last year when we got on to let's watch the old Dow theory because the transport index wasn't doing so well, although the Dow Industrials continued to make new highs, which went on to May. And then you had the give up on the transport. So in May we said, using the old Dow theory, the bull market is over. And then we were looking for credit spreads to start to widen in June and the yield curve to reverse to flattening, which both of those wouldn't be friendly to the banks. So then the view was that that was when we came up with it. July 7th, we came up with the quip that most bank stocks were very nice widows and orphans short. It looked like the change in the credit markets would do a number on the banks and that it was a safe enough trade that widows and orphans could short it. Well, yeah, that worked out, particularly in Europe where European banks, Deutsche Bank and Credit Suisse, they had their stocks actually, let's call it a crash. So then that gets us down into the start of the year when, again, in December, you had credit spreads widening, again, breaking out from a previous high. And then that pushed off another round of selling, and then it sort of exhausted itself here a couple of weeks ago. And you're getting a rebound in stocks. Generally, you're getting a rebound in a number of key commodities, a rebound in precious metals, on the key commodities, the main good one was the rebound in crude oil. So this then, on the commodities, fell into seasonal weakness, where often you can have an important low for crude oil in January. We got that. Base metals, copper, you can have a low in November. We got that. And so let's just call it relief from a period of forced selling. And on our books, we're looking for this rebound to continue into March. Now, today you've got crude down $1.30, various setbacks, but then it's pushing down the TSX composite, and it's setting back the senior index in the States, but it's had a good run. And the other one that was really a good run when you had the shocking January hit to the stock markets. And it wasn't so much of a surprise because, as I said a few minutes ago, the credit spreads broke out in their widening trend. I think it was December 22nd. So that set up another hit. So, and then of course everybody got excited because it turned out to be the worst start of the year in decades. And then it built on itself. So we've now got the relief going on there, and we'll look for it to continue. Also you had, with the hit to the equity markets and to the commodity markets, you had a rather good rally in long-dated treasuries, the long-dated government, Canada's. And we use in the U.S. on the Treasury the TLT ETF for it. And it rallied from, when the stock market was shining in November, 117. Then it got up to 125. And at that point, that was resistance on the long bond. And we thought, gosh, the traders have played this game many times, whereby you got to sell off in the stock market, let's bid bonds up. Treasuries up, and we didn't think it would work yet again because for the last year there's been a number of articles on the diminishing liquidity in long-dated treasuries. I mean, this is the biggest bond market in the world, and liquidity was disappearing on it. So, and the whole point is when financial assets are deflating, it's a sudden awareness of risk, and you can see it for credit spreads. But anyways, to go and buy a term risk in a treasury is a bit defying market forces. But at any rate, when it was at 125, we noted that it was at resistance. But who knows how high it can go. So it goes up to 135. The 135 level on the TLT is important because that's where it got to in January a year ago, which was on a fabulous rally, did upside exhaustions and everything else, so which we thought was the ending action move for long-dated treasuries. And now, who knows, we're back to that level. There was resistance. It backed off to 128, and today here with a little bit of a sell-off in stocks, it's back up again. So we had most of the move on long treasuries, but I think for the bigger picture on the long government market is that in January a year ago, it was based on crude oil prices crashing and weakness in stock market. And here you have, a year later, weakness in stock markets that pushed stock markets to new lows, and it also pushed commodities to new lows, but the long bond didn't make new highs. So, I mean, it was a great rally. 117 to 135, it's good, but it ain't making new highs. So we'll see what happens over the next month or so on it. Again, to wrap up on this, the investment side, the stock market and commodities can have a few more weeks to go on rallying. I don't know how much enthusiasm there'll be there to set a top, but we'll be certainly watching for the signs of failure on it.
On the crude oil side, Saudi Arabia and Russia said, hey, look, guys, we'll cap our production at January levels. Well, January was a record high production for both of them. So what kind of a cap is that?
Oh, they talk. And that's what it is talk. You've got crude oil is a very simple situation. And as we covered it in the first part of 2014, we figured it would rally up until around that May, June on a seasonal move, which it did. It got to 105 or 107. And then because of changing credit markets and the possibility of a stronger dollar, post-bubble deflation in commodities, we said that crude oil could go down substantially, and it could cause a lot of trouble going down. And we had two targets. One was to 1/3 of the high, which worked out to $37, and the other was to a quarter of the high, which worked out to 27. So we've been down around 27. That wasn't sort of like a technical chart on level picked off a chart. It was just, fall to 1/4. It could go lower, but once the prices started down, then you had the journalists and people in the business, directly in the energy business, had to come up with an explanation for it. Our explanation was simple. Post-bubble contraction, weak commodity prices, and a chronically strong U.S. dollar. And we put in that this crude oil was elevated because of the Middle East premium, but you had the example of natural gas falling to an entirely new and much lower price regime. So that was our argument. And then once it started down, then the journalists had to come up with stories. And one was that the Saudis didn't like the fracking production in the United States, and they were lowering price to be competitive and market capture and all that sort of stuff. And then you've got explanations now that they're going to reduce production to raise prices. This is all conjectural stuff. The main thing is that we're in a post-bubble contraction whereby commodities go down. And in the case of like the 1930s, when the price of grains were so important in North America, and what happened is each year the prices were weaker, so the farmers in each crop season would plant more. And the saying was that they would plant from fence post to fence post. Well, what you have going on in the crude oil business is that they're planting from fence post to fence post. So everybody's trying to sell as much as they can because their markup is so low, and those that are not within a markup get to go out of business. But with the fracking, it's an entirely new technological revolution going on, and you had something similar in the early 1900s with copper when they learned how to mine copper out of very large porphyry deposit. And the example is Bingham Canyon, just south of Salt Lake City, Utah. And that started production in something like, I guess, full production by 1910, and it's still going. So then later on in the 1970s, you had a technical revolution in gold production where you could do the heap leaching, and they learned how to mine disseminated low-grade gold systems. And then now you have the same thing going on in petroleum. So as the price goes down, they can turn off producers will go broke and then shut things down. But then as the price pops up a little, there are some of those that may be within the margin of making a profit out of it. So there's a entirely different new world now for energy, and the terrors of the Middle East were unable to maintain that premium in the product. So it's exciting to be in our business watching these big fabulous things happen and as they occur.
What about Canada's inflation rate due to the low value of the loonie?
Oh, don't get me going on that. This is absolutely appalling. One should have, back when it was at par with the U.S., they should have canceled the charter of the Bank of Canada, formed a currency board whose job was to keep it fixed at par with the U.S., and everybody would have been all much better. But here they go on, they say, well, the Canadian dollar's down, so exporters can make more money, but then you have to import things on the mining side or the petroleum side, so the cost of that's going up. It is a cheat, absolutely disgusting cheat, to allow the currency to go down and then to explain it as having some benefits. One I heard on the radio the other day was that, it'll be very good for tourists, huh? Coming into Canada, we should suffer, you get a 30% drop in the currency. You're going to get a proportionate increase on products you're importing from, say, the United States. And then the whole thing with depreciating the currency, it's not going to change the business cycle. That's elsewhere. So it's a futile, disgusting system, central banking, and the sooner we get rid of it, the better off we'll all be.
Well, it's been explained year to year, our food bill is 14% higher
than in the States, yeah. Now, also, there's sort of studies have said that whatever income bracket you're in, that in the States, in that same income bracket, it costs you about 20 or 25% less to live, between cost of products and the rate of taxation and all that sort of stuff. So, and even then, the governments and bureaucrats in the States are doing the best they can to rip everybody off as well. So maybe there will be a popular uprising against the governing classes who live the good life and spend their time taxing us and pushing us around, Here, in your face and in your wallet government is the way I've described it.
We'll have more with Bob Hoye right after the break.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Bird Dog and the Vintage Electric Band coming to Fort Langley, Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Bob Hoye. Bob, even as we see the equity markets in Canada and the U.S. decline, one thing I've noticed is that the little venture exchange has had positive numbers continuously. Not big gains, 5 points, but 5 points every day.
Yeah, it's been going up. The one thing that is really exciting is that there's an opposite action coming in between gold and the stock market. Stock market down, gold up, or the other way around, on a down day, on an up day for stocks, gold to be down. This can be constructive over time because I think we're in a cyclical bear market for the big equities markets. And then this going the other way, there'll be a cyclical bull market for the gold sector. And I know when I first came into the business, oh my gosh, that was a long time ago, Jim, 1960s. And on any given day, if there was a distinctive rally in the Dow or the Toronto Industrials, the Toronto Gold Index would be down equivalently. So I was with Wood Gundy then. I went into the head equity guy, and I'd been watching this for months and months and months, and couldn't figure out why it was doing it. So I went to the head equity guy, and I said, "Why does this happen?" He looks me in the eye, and he says, "Sonny, it's the way it works." So at any rate, it went away for a while. Now it seems to be coming back in. Maybe I don't know. I still can't explain why it is, but you get this opposite effect going. Because in previous post-bubble contractions, post-bubble deflations, we can call them that, the gold sector does very well. And even in the 1930s, early 30s, you didn't need the price of gold going up in U.S. dollars to do well in the gold business. You take Homestake, which is the premier producer in the States then, and with the boom of 1929, their costs of mining were going up, and their earnings were going down. They're cutting the dividend. The stock performed a bit with the bubble, but not that much. So, and then when the crash was over, you could have bought Homestake for $9, I guess a year and a half into the 1930s, 31. And then their earnings started to go up. The price of gold was still fixed at $20.67 an ounce, but their earnings went up something like 130% to the end of 1932, and the stock was up about 130%, and you know how much the stock market went down from 1929 to 1932. The reason why I'm talking about the end of 1932, because it wasn't until first quarter of 1933 when Roosevelt started fooling around with the price of gold. So this is why we watch the real price of gold, and when everything is deflating, lower copper prices, lower base metal prices, that shuts down base metal mining operations. That relieves workforce, so there's competition for wages and equipment and mining. And then, of course, crude oil is always a proxy for the energy costs, and you got to use a lot of energy to run a mine. So let's put it this way. Commodities are very weak relative to gold. And this will eventually feed into the profitability of the gold mining industry. And this is where we say that this is probably early stages of a cyclical bull market for the gold mining sector. And we'll watch it develop. In the meantime, the gold stocks, like you had the old Hoye index, it rallied 63%. And we looked at the GDXJ, which is a smaller cap stock index in the States, and it was up something like about 46%. And then we looked at Ziggy in Toronto, and it was up 40%. So most of the move was in the seniors, where you have greater liquidity, you'd have some funds buying and that sort of stuff. So I think there's going to be some corrections in there, but I think we're at the start of a cyclical bull market for precious metals industry, which is good. Now the investor will play in the stock side. Trading gold is essentially a currency play, you know. So maybe the U.S. dollar will go down hugely. Maybe all of those comments from wizards in the gold business that gold would go to 10,000 is not going to work out. But what you can have is a very good post-bubble deflation market, which is good for the gold sector, and we're going to enjoy it.
Bob, thanks a lot for chatting with us.
Yeah, Jim, good to be with you.
Have a great weekend.
You too.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. You can forward questions or comments to info@HowStreet.com and check out our popular YouTube channel, Talk Digital Network. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.